Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. Alright, so my guest today is Thomas Chua. Thomas is the lead editor and founder of Steady Compounding, where he runs a stock research service that focuses on compounders and also publishes his weekly newsletter. In today's conversation, we cover Thomas's investment style and philosophy, and also his story behind Steady Compounding. So please enjoy my conversation with Thomas Chua. Thomas, thank you so much for being here today, but maybe a good place to start might be the story behind Steady Compounding, and maybe why did you start it? So we'll dive into the details, obviously, but I'd love to hear some background as well and context to your life prior to where you are now, and I guess we'll go into the weeds from there.
Yeah, sure. Thank you for having me. Really happy to be here. So I have always enjoyed investing, but before Steady Compounding, I was actually employed by the Singapore government, and this story actually goes quite a way back, like a decade back. That was when, I was enrolled into military because all males in Singapore, we need to go through military. And that was when I started to receive acceptance from universities in Singapore. But during that time, because money was a constraint, my parents actually told me don't go to university, right? Just go straight to work so that I can provide more income for the family. And so the money was always a question, and that was when I signed a scholarship with the Singapore government. They paid for everything, including an allowance. So very grateful for that because it really allowed me to enjoy my education while I was in university. The challenge with that is that it comes with a 4 years bond, and so right after I graduated, I have to work for the Singapore government for quite a while. So I've always knew I like to be in the investment field, but because of challenges here and there, I ended up doing something else. And when I was about to leave the government service, there was a lot of fear, to be honest, because when I came from a place where money was a concern, having a government job was seen by a lot of my family members, as, you finally made it, right? You got this, what we call iron rice bowl, which is really like a job that, a really, really stable job, and you will not lose your income or anything like that unless you screwed up. And I was doing decently at that time while working in the government sector. So it felt like, I was doing something really foolish, at least to my family members. And that was when I was reading a lot of materials. And as an investor, I always read Jeff Bezos' work. And he shared with me this concept, which is called the regret minimization framework. So, I'm sure many of us know, Jeff Bezos, in his earlier days, he was an investment banker and he was earning good amount of money. And when he said he wanted to start an internet bookstore, his boss told him Jeff, this is a great idea, but perhaps it is not for someone like you because you're earning good money. Why do you want to do this? And this was in the 90s, where the internet was super abstract and not many people knew what it was. But, this is when Jeff Bezos, he used the regret minimization framework to make his decision. He tried and envisioned himself to be 80 years old. And if he never do this, never started out Amazon, would this be a regret? And his answer was a very conclusive yes. And off he go, It doesn't mean that we will necessarily succeed, but this regret minimization framework is a good way to think about, whether you should give your passion or something you really want to do a shot. And another thing that I considered was, I also read up a lot on Tim Ferriss's work. Not sure whether you got to check out his work, but he has this exercise called fear setting as well. So a lot of times we don't take action because we are afraid. We are afraid of failing, and sometimes there may be real consequences, financial consequences. And so I just set out all my fears on a piece of paper. And the truth is, most of the things we want to do, it will not damage us permanently, or it will not cause us to set back permanently. It's usually recoverable. And when I think of starting something online, like right now I'm writing Steady Compounding full time, whereby I write about research reports for my subscribers. It is something that allows me to gain a lot of leverage, or what Naval, this is something I learned from Naval, right? Because when you do something on the internet, you only do the work once, but you are able to scale it infinitely, right? There's no more incremental costs to generating that incremental amount of revenue. And so like when I think about the risk reward trade-off, it's probably just maybe like 2-3 years of lost income. But from here, I gain a real shot at, really creating something that could give me the right tail end of the rewards. And that was very attractive to me, and worst come to worst, I have my investments to cover my expenses, or either that I can just go back to employment. There's always that option left on the table for me.
Yeah. So how far back were you planning to sort of start up steady compounding? Like, were you always inclined to write and share your work? Like, what was your, I guess, early passions or decisions on doing that specifically?
Yeah, so because my bond with the Singapore government was 4 years, at the third year I started to take action. Because a lot of times we talk about finding our passion in life, but we can't sit there and think about what our passion will be, or we find what people like to call ikigai, the job that's meaningful for you but yet pay at the same time. We have to take action. Then, if it fails, we try again. And so that was where I started steady compounding. Initially, I started it out as a way for me to put my work out there. It's like an online resume, to find a job that would allow me to go into the investment sector. Even though I studied finance in university, but because my work experience was tax related when it comes to the Singapore government, I thought, putting my work out there, my thinking out there would put me in a better position to get a job in the investment field. But the gratifying thing was that after I started publishing online, I started to attract a lot of the people in the investment field who told me like, you're writing good stuff. And then I just started to network from there. I started to learn a lot from other investors in Singapore and abroad, like we just set up Zoom call and then we just discuss ideas. So that was a lot of very good feedback loop. And the more I write, the bigger the following. And that was when I thought, perhaps I could take this somewhere else, because I was getting so much learning done. I was meeting a lot of great investors. Why not I try and be an independent writer? And then that was when I took a pivot from it becoming just an online resume to becoming writing full-time and publishing like research reports to my subscribers almost on a monthly basis.
So you mentioned sort of other people giving you compliments gave you a bit of inspiration, or maybe gave you a bit of a push. But if you zoom out a little bit, are there any aspects of maybe writing or investments that you think are pretty easy or natural that come to you?
Yeah, so I'm a very curious person, like how things work, not just in investing, but in many other aspects of life as well, like history, or even, biology and all that. So investing suited me really well because it is sort of like a method for me to get paid or grow my wealth while just satisfying that curiosity. And so, Charlie Munger always said, like, he never seen anyone who's intelligent but, isn't reading all the time. So that reading portion or satisfying my curiosity comes very naturally to me. And so I'm always eager to learn new things. And so I guess that part is easier for me. Yeah, and so and another way to satisfy that curiosity is really to just go out and meet people. Like Eugene was the one who connected us together, so I met him and a few other investors, and so that is where the competitive advantage comes from writing online. It is only by writing online then I'm able to draw like the different investors into my life, and when the idea exchanges starts coming in, because I think there's only so much time we have. And sometimes the highest return on investment way to spend our time is to bring our work, share it with others, and then others share their best work with us. And, and that's what really provides a lot of really good investment ideas.
Yeah, it's almost like a magnet sometimes, isn't it? You can sort of go find people, but if you put enough work out there, sometimes people come to you and it makes it a bit easier, eh?
Yeah. So just by writing online, you will be attracting a lot of different people into your life. And some of them, they are really, really good investors. So I know this term is used a lot, but it becomes like a flywheel, ideas just keep coming, and then you have to evaluate them yourself as an investor.
Yeah, perfect. So what does your writing process look like then? Like, what might a typical day look like for you then?
Yeah, so I'm an early bird. I typically wake up around 5 a.m. in the morning. And to me, the morning time is super important. I try to block out and really protect that timing. There's a lot of research that shows that your mind actually learns the best the few hours upon waking up. So that is where I do my learning and writing. I generally don't eat once I wake up. So my first meal would begin around 11 a.m. or so. Yeah, so from 5 a.m. all the way to 10 plus, it will be just learning, writing. Journaling is also a big part of my routine. So I try to write once every morning and once at night. So in the morning, I will write down 3 things I'm grateful for. The reason for that is because humans, we are naturally wired to focus on problems, because that is what helps us survive in the past. But in today's society, in today's time, that mechanism sort of kick into overdrive when there's so much information, and the news is bombarding so many things at us, and it's easy to be go into overdrive and be depressed, stuff like that. So writing 3 things I'm grateful for sort of just rewire my brain to focus on the optimistic aspect of things. And then I'll write down 3 things I could be doing today to make my day go well. And so that's how I start my day. And then from there it's reading, writing, and then I'll hit the gym, around afternoon time, because that's where my productivity will take a dip. And then in the afternoon, that's where I schedule all my meetups, or, this podcast is afternoon time right now. And otherwise I'll just go back to working and writing. My brain typically shut off in the evening or nighttime. I don't think really well during that time. So that's where I take a walk, bring a notepad with me. If there's ideas, that's where I'll start writing down all my ideas. And then before I sleep, I'll just write down to-do list for tomorrow. And this habit is really copied by the Stephen Covey, the guy who wrote the 7 Habits of Highly Effective People. And that really helped, get my life in order and ensure that I'm productive and growing every day.
Yeah, mate, you're a machine. So in terms of reading, like, what do you like to read? Is it biographies? Is it what type of newsletters? Anything specific? Like, do you reread much? I'd love to hear about your sort of reading patterns and habits.
Yeah, so the way I go about reading, right, is if I find a good book, I get my next reading list from the appendix of that book. So like, for example, The Joys of Compounding is really a great book. The author, Gordon Bate, he really shared a lot about the investing concepts that he know. So when I chance upon a great book like this, I'll go to the appendix, and then that's where I start to look for my next recommended book. There are a few books that I would really recommend, especially for investors who are just starting out. Like Peter Lynch's book is great. Joel Greenblatt's is great. Gordon Bate is great. 100 Bagger I think it's by Chris Mayer, if I remember his name correctly. Yeah, his is also a great book. And a lot of times, right, if your priority is when it comes to is investing, these books, they will also include the research papers that really shape their thinking. So I love reading all these white papers as well by Michael Mauboussin, if I'm pronouncing his name correctly, and Epoch Partners. These are really great sources of information for investors. Then when it comes to growth philosophy, I usually like to follow folks like James Clear. And then there's also Farnham Street. That's also a great source of information. And because the quality of our mind is very much a function of the information we choose to consume, I'm always very cautious about what kind of information I allow. So when it comes to social media, I mute or unfollow very routinely. I always try and clear up my algorithm or my inbox, etc. I try to make sure that it is only high quality information that's coming in.
No, fair enough. And in terms of what you've learnt along the way since starting, like what's been the biggest lessons you've picked up writing wise, or even just like sort of how your process is, I guess?
I think writing wise, a good person to learn from would be David Perel. Not sure whether you come across him on Twitter, but one thing he mentioned struck up to me early on, which is really we go to social media to seek the traffic flow, right? But it's important to not just rely on social media like Twitter or Facebook, for example, or even YouTube, because we never know when the algorithm will change against us. So it's important for us as writers to convert this traffic into subscribers, email subscribers. So that has been helpful when it comes to my starting out process. Then other advices that I would usually give writers would be try to write extremely frequently when you're starting out, because you are trying to find your unique voice. And I find writing for yourself much more enjoyable rather than writing for everyone, because that's where I learn the most. I only write things that's helpful to my thinking. I try to compress them into ideas. And when I'm writing like investment thesis out, it really helps make sure I understand the concepts. Otherwise, I'll go back to look at the annual report or talk to other investors to make sure I understand these concepts. Investing wise, there are two things that really changed for me over time. So when I first started out, right, I was really looking at like dividend companies or deep value investing, because those are quantifiable. I wasn't really into growth investing until maybe like 4 to 5 years back. So that was a big aha moment for me. If I started out earlier, the results would have been even better, because initially when I was looking at especially the dividend stocks, company they are giving out a lot in dividends. They are usually like already big in size and have already approached maturity, sometimes going downhill if we are looking at the S curve. Yeah, and so I wasn't very open-minded to loss-making companies, or companies that are super high PE. And that was really a mistake when it comes to the way I think about valuation. And I like the way Howard Marks put it, that there's really not a difference between value investing and growth investing. What we are trying to do today is just buying something today that's cheaper than tomorrow. We are just trying to make that returns, and that really is the way to think about it. It is only after I learned to focus on unit economics and then learn about operating leverage, that's where it really opened my mind out to a different type of investing. And it took me like so I started investing about 14 years ago. Yeah, it took me many years before I arrived at this stage. And it always reminds me of a quote by Charlie Munger. The human mind is a lot like the human egg. Once an idea gets incepted, it will automatically shut off to other ideas. And so like I always try to keep an open mind. Like if an investor with a different investing style approach me, I try my best to listen with an open mind to see whether of my my existing ideas that can be challenged. Another idea that really changed when it comes to investing is about options. So I always had the conception that options is something that's super dangerous. But actually, when I went to learn how Warren Buffett used it, I thought it was super intelligent, because the way he used it to buy Coca-Cola in the past. So just a brief overview of options. Options, the pricing is based on volatility, interest rate, duration, but mainly based on volatility. So the way Warren Buffett uses it is when he wishes to buy Coca-Cola back then, he actually sold put options. Put options means like if Coca-Cola fall below a certain strike price which is set by him, he will have to buy Coca-Cola. And before the order gets before we hit the expiration date, he actually collects the premium upfront. So it's a lot like insurance, something which he likes. And with that premium, right, it's sort of lower down your purchase price when you account that into fact. So I thought that's just a really brilliant way of buying companies you already want. So rather than buying outright from the market, right, there are times where we could sell put options, collect the premium to offset our purchase price. Yeah, so these are really the two biggest things that evolved since I started investing about more than a decade ago.
Yeah, I love that you have an open mind because, yeah, it's very hard. I was the same as well. I was very much deep value and I would just blow past any idea that wasn't. But you mentioned that aha moment from deep value to growth. Like, what was that? Was there anything you read specifically or maybe someone you spoke to? Like, what was that aha moment?
Yeah, so the first one that made me question whether dividend stocks is the best is Terry Smith, right? Because he always talks about as investors, we shouldn't be focusing on the dividend returns. We should be focusing on total shareholder returns, which is really a function of both your capital appreciation and the dividends we receive. And that just made a lot of sense to me. And the second thing that, really changed my mind is back in, I think, 2017 or 2018. I saw a research paper that shows the intangible investments made by companies have actually way exceeded tangible investments. And the cross point was in 2017. And since then, it has widened even more and more. And it just shows that a lot of these companies that's capturing a lot of value nowadays, they are making intangible investing. And the old way of value investing may need some tweaks to its thinking, right? Because we used to be very focused on the tangible assets. But nowadays, when you look at the companies, a common one, let's say Google or even Facebook, they don't really have a lot of assets on their balance sheet, but yet they are making a lot of money. And when we fall back to our, more traditional metrics, like especially for deep value investors, we love to look at maybe price to book. The assumption is that these assets are generating income. But now there's this group of company with very little assets, but they are generating even more income. But coming from a, deep value investing background, I sort of resisted against assigning a very high valuation for a company without that assets to back up, But that thinking has to change when I saw that. And the previous thinking was that, without assets like this, what is their moat? But actually, a lot of this company has even stronger moat, like, our network effects or very high switching costs. And so they're able to capture their consumers in an even better way and, really deter against competition. And the beauty about the newer breed of company nowadays is that they tend to have a monopolistic or oligopolistic structure. Instead of like, let's say restaurants, it is usually super competitive, the margins are low and all that. But when it comes to like the internet or platform, especially platform companies, they have a tendency to go towards a winner take all market. And this is where, as shareholders, when you invest in companies like this, they are able to generate a lot of returns for us as shareholders.
Yeah, and you don't have a geographical focus or constraint, do you, if I've got that right? You're pretty happy to invest anywhere?
So the thing about being a Singaporean is that by default, we have to go overseas because the market is just small here. Like let's say I invest in a company, a F&B here in Singapore, we only have a 5 million population. Like just within a few years, it's not going to grow anymore. And there's this quote by Charlie Munger also, which makes a lot of sense. Like the rate at which we can compound our wealth is very much dependent on the return on capital and how much that company can grow. And so investing in Singapore companies is tough because we have to fish where the fishes are, and there's just not a lot of fish here. So I'm very comfortable with investing abroad, US, Australia, Hong Kong, or even UK. Yeah, so these are typically the markets I look at.
Yeah, and maybe from then, what does your idea generation look like? Do you run screens? Is it just a function of reading and chatting to other people? Like, what does that look like?
Yes, so I enjoy reading. That's where most of my ideas come about. Every time there's a IPO or there's a new company that come about, I generally don't invest into IPO, but I'm just naturally curious about what's this company that's coming online. And over time, reading the earnings call, etc., it gives me a list of ideas, or rather a watch list for me to dive deeper into. If they're higher quality companies, that's why I do a lot more research. And then the other good source of idea generation is really coming from networking with other investors, because there's only so much time we have. And a lot of times, like other investors, they come with different experiences. They may be able to see something that I'm not able to see, and so just by asking them a lot of questions, and a lot of times these investors are very generous with sharing their ideas, especially like, I also share with them my ideas, so a lot of these ideas just keep coming in, and for me to work on and then decide whether I should initiate an investment, go into a deeper research, whether I should spend my time on them.
Yeah. So we've mentioned about what maybe you look for and stuff and some of the positives, but to invert, like Charlie Munger would say, is there any certain criteria or specific situations that you really avoid investing in? Like, is there anything you just refuse to touch, and maybe why?
Yeah, so it's not that we can't make money in asset heavy companies, but generally I try to avoid those. Then companies that don't interest me, I avoid those also. And those that are too complicated, because there's just so many companies we can look at, right? So I don't look at pharmaceuticals or anything that's too complicated. I've been trying to look at the semicon industry, still working on this one, but it's not as intuitive for me as opposed to companies in the FMCG sector, or the SaaS industry, or even e-commerce. Those are really intuitive for me. But generally, when it comes to avoiding, I avoid asset heavy companies, because like the way we grow our wealth is very determined by how fast this company can compound. And with asset heavy companies, a lot of the free cash flow would be locked up in inventory, or in replacing the assets, for example. So even if they are showing profits, the free cash flow may not be coming out. And for us as investors, free cash flow is really what matters at the end of the day. They don't have to show free cash flow today, but the question I always try to ask myself, like, will they be gushing with free cash flow in the future?
Yeah, so when you pull up the financial statements, when you're looking at a company, is free cash flow the first thing you're looking at? Like, just walk me through start to finish what you're looking for, what gets you excited, and yeah.
Yeah, so that's a good question. So a lot of these internet companies, especially SaaS company, they don't have free cash flow at the moment, right? Because they are just reinvesting so heavily. So the first question I always try to ask myself is whether they have a moat, because for them to be profitable for me as an investor, they must be able to sustain that competitive advantage many years down the road. And then the second question I try and look out for is whether their unit economics make sense. The cash they're spending out in terms of R&D and marketing today, are they able to bring those back? And that is really where the customer acquisition cost and the lifetime value analysis comes in. If that metrics makes sense, then I'm actually alright with them not coming up with free cash flow or showing a net profit today. Because if the unit economics is positive, eventually it will show up. So when it comes to loss-making companies, these are really the two factors I try to think about: whether they have a very strong competitive advantage and whether their unit economics make sense. And a lot of times, this will tie back to the more qualitative aspect of our analysis, which is to analyze management. Whether they are driven, whether they are driven is super important, because that is something you can't train. Whether they are ambitious or not. And when we look at the management team, we want to make sure they are very upfront with us shareholders, and their acquisitions actually make sense. And we can do that by really dialing into every single earnings call to listen to their tone, how they answer questions, and stuff like that.
So how do you view founder-led companies then, for example? Do you prefer them? Is there a bias towards them, against them? How do you view it?
Yeah, so founder companies are definitely preferred because they are just more driven. But it becomes tricky when it comes to companies in Hong Kong, especially when they hand over their management position to their children. That's where a lot of problem comes on. But when it comes to investing in the US, especially a SaaS company, if it's founder-led and the founder has a large stakeholding, that is always a plus. And then I will go onto Glassdoor and LinkedIn to really do the scuttlebutt, to see what the employees are saying about the CEO, whether they buy into his vision. Because when it comes to going on earnings call or giving interviews, these CEOs are usually extremely charismatic. So we have to do the second level check to see what their employees are saying. And if those checks are good, then founder-led is definitely a plus.
Yeah, so you mentioned doing the secondary level research like Glassdoor and stuff. Do you have any other maybe obscure research methods that other people may not do? Like, is there anything you do in your research process that you think other people don't maybe replicate and they could learn from?
Yeah, so frequently I would actually talk to the employees of the companies. In fact, when I started writing online my analysis about these companies, the employees actually come to look for me and share with me more about their company. Otherwise, I'll just go on LinkedIn to chat with the companies. Sometimes I will. Not sure if I should be sharing things, but sometimes I will, pose as a potential customer so that I can understand the product, and that's where the salesperson will pitch to me, and then that is really a quick shortcut to understanding how their product work, and then you try to ask questions to see whether this product, whether there's high switching costs, etc. Yeah, so. And like what Peter Lynch do, usually you can ask the salesperson about the competitors, and if they have to choose a competitor product, which one would they choose? And that is usually a good indicator what is the next company you should be researching on. Yeah, so I mean, I frequently go and speak to these salespeople, or sometimes if they are willing to share like what their working experiences is like, that's why you get very real conversations beyond what is usually shared on the public by the management. Yeah.
Yeah, mate, I love that. That's so cool as well. Are people pretty receptive to that when you reach out? Like, do you know these people beforehand, or is this total cold email reach out? Or
yeah, so I mean, a lot of people will ignore you, but generally there will be a few who would be very happy to share. Usually I don't come across to them as an investor. I just come across as someone who like to learn more about their company and what their job entails, so that I can really consider whether maybe I want to be an employee, for example. So that's how I approach it. And usually they are quite willing to share, on a 15-minute calls or something, about what their job is like. And yeah, and that's how a lot of this information, a lot of these answers would come in, which you usually would not get studying annual reports or just listening to what management say.
Yeah, no, mate, I love this research. It's great. Maybe you don't have to mention the company names, but do you have any specific examples where this has come in handy? Like, do you have any moments where you're like, this is very useful? Or
okay, so like I'm invested in C Limited, and so I write about C Limited a lot. I go on podcasts to talk about C Limited a lot. Yeah, and so sometimes I have a lot of friends who are employed in C Limited as well. So this is where like I get a better understanding about what the company's strategies are. Like, for example, if they are going into fintech, what are they planning to do, etc. So that I can better align these numbers to the stories. Like, what are the strategies the company really, really want to do? Of course, they don't give me any insider information that is not supposed to be released, but it just helped me piece the picture together in a better way. And especially when the market is reacting extremely volatile, like especially downwards volatility, like maybe they are saying company X, they are reinvesting so much, it's loss making. But when you're able to understand like why the company is losing money, because they are reinvesting into a extremely rapid growing sector, then as an investor, I'll be more grounded in a sense, because I understand what the company is trying to do, and that will very likely show up several years down the road. But, Wall Street is usually very short-sighted. So, and when they can't piece the picture together, that's where, as a retail investor or as someone who does a bit of scuttlebutt, that's where the edge comes in.
Yeah, and it's great because, you're piecing it all together. And even just, like if you talk to employees and they all hate working there, no matter how good the business is, you're kind of a bit iffy, aren't you?
Yeah.
And for C Limited, it'd be super handy because they're so forward-looking. So to get the employees' perspectives on how things are going, that's probably a huge edge that not many people are willing to do, I bet.
Right, exactly. But sometimes we have to discount what the employees say. Like, we have to do our own judgment because sometimes they just like to complain, which I get that quite. Usually the chatty ones are the ones who like to complain, and so usually you have to talk to a few in order to have a more holistic view of what the company is trying to do.
I love that bit of specific advice. So you got to watch out for management being over-optimistic and overly chatty employees complaining too much. Before I get into my closing round of questions, I'd love just to hear, so with your content and steady compounding, like what's the plans going forward for that, and where do you see that going, and what do you hope for it, I guess?
Yeah, so my plan for steady compounding is really to keep growing my audience, so that my work can reach out to more people, because I have been a beneficiary of many who have put out this information before me. Like, for example, John Huber of Sabre Capital, or even, what's the other fund called? Intrinsic Capital? Yeah, so like a lot of these previous bloggers have put out so much in public such that I can benefit from it. And that is really what I'm trying to do, to put out content out there so that others can benefit. And of course, to grow my paying subscribers as well. Because I'm putting out a lot of this research report out there, which I think could really be beneficial to retail investors who are out there looking to invest in a lot of these, what I would call compounders, what FinTwit would usually refer to as compounders, companies, high quality companies that are able to compound at a very good clip for a long time.
Yeah, so to move into my closing round of questions, what do you think is the most undervalued life experience that university-age students don't give weight to? Like, what's an underrated skill or an experience that you think they should have, or that maybe you wish you had at the time?
I think that there are two things. One is to network as much as you can, because people are just very receptive and willing to mentor young people. So try and reach out. Don't be afraid of rejection. Reach out to people, and they will share a lot of insights which you may not otherwise get. And then the second thing is really to start publishing content instead of just consuming content. Because the best way to network is actually to be interesting, and by putting your ideas out there, you will attract a group of people who are willing to share their ideas with you as well. And that's where you really start to grow and build up your brand equity.
Yeah. So we've spoken a little bit about the investment books that you've read and liked, but has there been any other books that have been influential in shaping your worldview?
I think the Poor Charlie Almanac has been one such book. And of course from there, that's how I know Ben Franklin's biography. So that has been very instrumental as well. Then also James Clear, Atomic Habits. I think that's something everybody should check out, because there's just so many actionable tips inside that book that can just improve your life by a lot.
Yeah. And so, where do you think maybe the biggest opportunities lie for today, for youth today? Like if you were 18 today, where would you be spending your time and how, do you think?
I think I'll spend a lot of time pushing content out rather than, just focusing on doing internships, because I think especially in Singapore, when you look at what your peers are doing, you have a tendency to feel stressed and follow suit, and a lot of peers will be fighting for internships in investment banks or the tech companies. Those are good, but also do remember to dedicate a portion of time, to publishing things online, because that's where really the limitless leverage comes in. You're able to push out your ideas at no cost to a limitless amount of people, and this is just a great time to be in today. Like not just on Twitter or Reddit or or Facebook, but I think recently there's also the rise of Discord, where a lot of people are just exchanging ideas over at that platform.
Yeah, Discord especially, I'm really trying to get my head around and get it going, you know what I mean? Like, it's just so much opportunity there, eh?
Yeah, man.
Thomas, I've had a blast today. Anything else you want to plug, or where can people find you?
Yeah, so people can find me at steadycompounding.com, and also you can find me on Twitter at steadycompound.
Perfect. Thank you so much.
Awesome. Glad to be here.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. Either way, links to all content mentioned will be in the description below. Also be sure to sign up for my weekly newsletter, curated by Kalani, where I share what I've been reading, learning, and watching for that week. Same as the podcast, it's compressed to impress, and I aim for maximal return on your time invested. Sign up at kalanis.substack.com. So that's KALANIS.substack.com. You can also connect with me on Twitter at ScarrettKalani. But until next time, have a good one.